All right, good evening everybody, and welcome back to New York City. We'll just do a quick audio and visual check. So if you can hear me and if we are streaming in 1080p, just go ahead and give a thumbs up in the chat and we'll kick this off here momentarily. I just landed in New York City, very early Sunday morning. It's good to be back. I'm happy to be back. I'm just not too enthusiastic about the temperature. So we'll get started in a moment. All right, it looks like we're good to go here, guys. So we'll hit it and we'll get started. So welcome back, everybody, to Walks and Wall Street. Today is Monday, January 22nd, 2024. It's 9:09 p.m. Eastern Time here live from New York City's Billionaires Row. We're on the corner of East 57th Street and Madison Avenue, and of course, as always, we're right here, standing pretty much at the bottom of the base of 432 Park Avenue. This is one of the most exclusive and luxurious buildings anywhere in New York City. And we're sort of streaming live from the courtyard here. I'm glad to be back in New York after a much needed hiatus and a little bit of a break. Hopefully all of those who are new to the live streams enjoyed seeing a little bit of change of scenery, a little bit of change of pace. We were streaming live from downtown Miami and Brickell over the past week, but it is good to be back in New York City. Although I am coming from 82 degrees and sunny to about 22 degrees and cloudy. So gonna take a few days just to readjust and reorient my body to the temperature, okay? Now, we have a lot to talk about tonight on the live stream, but we do have just a few announcements. I did send out the second issue of our free financial newsletter, the Behind the Street newsletter, on Thursday night. Now, this was quite a lengthy piece, but I thought it was important to make it lengthy because we covered a lot. We covered a lot of material. As you know, it is the beginning of earnings season. And at the beginning of earnings season, who kicks us off? It is all of the major Wall Street mega banks, financial institutions, and particularly credit card issuers. So there's a lot of information we can gauge from the very beginning of earnings season. And in the newsletter, we were sort of watching this trend, following up on this trend that we've been watching across JP Chase, Bank of America, Citi, and Discover Financial. Now, what we've been seeing is a very steady trend towards higher credit delinquencies. Now, obviously, we're sort of using Q4 of 2019 as the benchmark, right? Because once the pandemic hit and consumers started to get unprecedented amount of pandemic stimulus, people were actually using that money to pay down their debts, make good on their credit. So NCLs, or net credit losses, actually plummeted on Wall Street. But one of the things that we've been seeing as a lot of this pandemic stimulus is tapering off here, we're starting to see higher credit delinquencies accelerate towards pre-pandemic levels. Now, this infers that consumers are burning through the savings built up throughout 2020 and 2021. But it is not a cause for concern just yet, because Q4 of 2019 delinquency levels weren't all that bad. So I wouldn't say it's a cause for concern now, but it is something to watch. Okay, so at the beginning of earnings season, we can use a lot of the data that we get from Bank of America, from JP Chase, and we could use that as a proxy to gauge the health of the U.S. consumer. So I just want to, take you behind the screen here a little bit, just to sort of show you, what we were writing about this week. We did a deep dive into the major banks during earnings season. Now, these are direct excerpts from the earnings deck of Bank of America, and you could see their NCLs, right, or the net credit losses, credit loss provisions kind of going up, and also the charge-off percentages. So total net charge-offs of Bank of America ballooned to $1.2 billion, increased about $261 million from Q3 of 2023. Same thing, same trend is happening here at Citibank. We did a complete deep dive here. We've taken exact slides from the deck for earnings at Citi, and this is a very important metric to watch here, okay? So if you want to read that, go ahead and check your email. I sent that out to everybody, or you can just scan the QR code on your screen right here, and you will be able to get the link to receive all of that research for free. If you can't scan the QR code, you can just type !news, NEWS, in the chat, and the Nightbot will drop the link to our Substack. Last thing I want to touch on really quick, okay? Because thinking out into next week, why is next week important? Well, we'll talk about why. If you look in the chat, if you scroll back up in the chat about 2 minutes ago, I posted a link to the Board of Governors of the Federal Reserve System, okay? And this is the meetings calendars, this is the statements and the minutes dating back to 2019, going forward to 2024. So January 30th through the 31st is going to be the first FOMC meeting of the year, okay? The Federal Open Market Committee meeting will be taking place next week to close us out of the first month of the year. Now, this is important because if you head over to the newsletter, right, I included some very interesting links. I included the link to the CME Fed Watch tool. This is essentially the futures market we're looking at. And right now, check this out. And I don't know if I agree with this, by the way, but this is an exact snapshot 2 days ago from the CME Fed Watch tool, and the probabilities of a rate cut at each consecutive essentially FOMC meeting. Now, according to this table, at the end of the year, right, so December 18th of 2024, the market is pricing in about a 34% probability that the Fed funds rate is going to get cut all the way down to 3.75 to 4%. So, right, 3 3/4 to 4%. It's currently at 5 1/4 to 5.5%. So the market is telling us that it is expecting a rate cut at every single FOMC meeting, excluding the one that we're going to have next week. I don't know if I agree with that. That's just what the probabilities are saying, and that could have a massive impact on the market. So if you want to, try to understand all of this a little bit better, again, I emailed this out to the group. So check your email. You'll see it from Walks in Wall Street Behind the Street newsletter, or scan the QR code on your screen, or just type !news, NEWS, in the chat. And again, every other Thursday after the market closes, you will receive all of our equity research for free. Okay, it's a great way to support the stream, and it's a great way to stay up on the financial markets. All right, with that being said, let me go ahead and close up my laptop here. I'll put on my hat. I'll say hello to everybody in the chat, and we will go ahead and get started. Welcome back to New York City. Hopefully you guys have your hat and gloves on here. Let me just go ahead and get the QR code off the screen, and we'll get started. All right, let me scroll up to the top. I see Michelle Frank is here, 21st Century Visits. Brian is here, says good evening. British Gray from Tampa, Florida. Touted Tara, Cynthia Beal, Sarah Silva. Estelle is here. I see Joe Ratz. B Pet Show. Good to see you. Jen Claus, Wendy England, D is here. Oscar, Western Mass Dave, the one and only, God bless. Rebecca's here. Frank, 7-9 Frank, what's up? Vincent Lee and Hawaii. Welcome. We have our good moderator, Cosmo Scary. What's up, Cosmo? Hopefully you're having a fantastic start to the year. Thanks so much for being a good moderator throughout 2023. Julian says warm up. Yeah, so I got a hat on. I got a big puffer jacket on. It's actually not too bad. Now, I've said this before, I don't really mind the cold. I really don't. I mind the wind. And so long as it's not windy, I'm good. But the moment it's windy, good to see you. Welcome to all of our Canadian viewers. We're now on the corner of East 56th Street and Park Avenue. Now, the building we're seeing here is 425 Park. This is one of the newest Class A office towers in the city. Whoa, look at that view. I was not expecting that. That is so cool. You kind of see these very sparse clouds and the moon literally standing right on top of 425. That's a cool shot, right? Hey, Gary Carpenter. Welcome. Thanks for joining. Alex R says, I want to move south where it's warm. Yeah, I mean, you know, I had a great time in Miami. It was an amazing visit. It's always never long enough. But the good news is business is starting to pick up and we're seeing a lot of client interest in South Florida. So hopefully I will have my license very, very soon. And we'll be doing deals in New York City and Miami. Now, I met with a really, really good quality group of people. They're developers. They have an amazing new project that's going up in Satellite Beach, Florida. Now, Satellite Beach is probably about 2.5 hours north of Fort Lauderdale. And they were so kind and they were so nice to invite me in their office, give me a rundown on the project. And I'm excited about it. So the project is called Lumina in Satellite Beach. It's going to be 3 stunning towers, 44 units each, 132 unit project. And listen to this, they haven't even broke ground on the project yet, and they've already sold over 20 units. And I really didn't know this before, but you know, if you think about Satellite Beach up there, and I'm not very familiar with that neighborhood, right? I'm not familiar with Brevard County. But what's exciting is that the job growth down there is so explosive. You have SpaceX is bringing a lot of jobs down there. I think that's where Elon Musk launches off a lot of the rockets. You have the other billionaire, the other competitive billionaire, Jeff Bezos with his Blue Origin is down there. And then you also have Grumman. So there's a lot of very lucrative careers like rocket scientist jobs that are going to be bringing a lot of top talent to Satellite Beach. And there's not a lot of very high-end product for those type of people to live in. So I think this is a cool project. Very interesting to watch. Hey, NBA Elias, good to see you. Thanks for joining us. Yeah, Layla says, I've honestly never heard of Satellite Beach. I haven't either, to be quite honest with you. I'm really only familiar with Miami-Dade County, mainly, I would say, south of Sunny Isles Beach. That's sort of my expertise, if you will. So looking forward to, you know, learning more about other neighborhoods in South Florida for sure. I see Foxing is here. What's up? Jules says, hey Tom, how you doing? It's been a busy few weeks traveling and working. Sounds like things are going well. Yeah, things are going good, thank God, right? It's just been very busy with the travel. But yeah, all is good. Hey, someone says I work at 445 Park Avenue. Very nice. Love that. Yeah, so, you know, we'll just do a quick market update. I think this is going to be a shorter than normal live stream just because it's so cold and I didn't bring my battery pack, so my phone may die. But I'm not sure if we covered this in Florida, but the S&P 500 hit a new all-time record high. So the S&P did break out. And if you look at a lot of the liquid leaders in the S&P, right, There's always a great free resource that I mention on the stream. If you go to slickcharts.com, once again, slickcharts.com, great resource. It breaks down the S&P 500 by weighting, right, by market capitalization. So take a look at the top 10 stocks by market cap in the S&P, and then go through them individually and look at how they're trading. Pretty much all of them, with the exception of Tesla. Tesla's been a real laggard in the top 10 in the S&P. I mean, NVIDIA has been an absolute monster, right? So tech, a lot of these big tech-heavy companies, right, within the index are really propelling the indice higher. Some names are extended, but it's been very, very powerful on these breakouts. Another sort of semiconductor-esque company, MSCI, or SMCI, excuse me, broke out up 20% in the new all-time record high territory. The only thing that's lagging, and I think many of you have pointed this out in the live stream before, Russell 2000's sort of truncated and lagged, right? We have pretty much all of the major equity indices, the S&P 500, the NASDAQ, and the Dow, at all-time record highs, but the small caps are really struggling to find their footing, which I guess kind of makes sense, right? As we're now walking down Billionaires Row, you can see the Steinway Tower in the distance and Central Park Tower 2. But we're still in a heightened interest rate environment, and higher interest rates really puts a lot of pressure on small caps, because small caps have a high percentage of floating rate debt as opposed to fixed rate debt. And as interest rates go up, a higher percentage of their revenues have to go towards debt pay down, right? Servicing their debt. So it's much, much harder for these small cap companies to service their debt and take on new debt to fund operations when interest rates are rather high. So we'll keep an eye on that. Hey, Teresa Diaz, TD is here. Good to see you. Our good friend Abdullah says, hey Tom, glad to see you back. I'm happy to be back too, not gonna lie. Although I wish it was warmer. That's really the only thing I'd say. Definitely wish it was warmer. Jonathan from Florida says, hey Tom and team, watching from Pompano Beach. So it's funny, Sunday morning, as you know, I took a 6 o'clock flight out of Miami International. It felt colder than it is right now, because I had to ride the scooter to the airport, and it was only 52 degrees at 4:30 in the morning when I was riding the, the Vespa scooter, whatever you want to call it, to the airport. It was cold. I always say, if it's 52 degrees in Miami, it feels like it's 30 degrees in New York. It's cold. Hey, Sharon's here. What's up? Good to see you. Marvin, welcome. We'll go up by the Apple Store. We'll do one quick pass. Tug Carter says, Tom, so glad you're back. Walking tonight in New York City. Thank you so much, Tug Carter. Appreciate it. Sean D, so it's a good time. It looks kind of cold, very cold. Try to stay inside as much as we can tonight. But I know we've been talking about stocks for the first 15 minutes of the live stream. I want to shift gears for a minute, if we may. Oh, look at this Cadillac. This almost looks like one of those motorcades for the president, doesn't it? This looks like an armored, sort of bulletproof Cadillac. I don't know if it is or not, but it kind of resembles the motorcade a little bit, at least. Hawaii says, Tom, did you update the registration on your Vespa? I got to do that tomorrow. I got to sit down at the office and do it. But thank you for reminding me, by the way. NBA Elias says, Tom, I hear office rents up in Miami-Dade, down in Broward and Palm Beach, continues into the fourth quarter. I haven't really been following that, but I would assume that sounds correct. I mean, man, you've had like a boom in everything down there. So, I mean, you are starting to see some cooling. Talking on the residential side, like I'm trying to help a client now find a couple rentals in Sunny Isles Beach. And these things have cooled, I wouldn't say substantially, but they've come down from the nosebleed prices, you know, of the pandemic, when everybody was escaping from everywhere to move to Florida. The one thing I would say that Miami-Dade County has going for it, as it relates to, you know, trying to bring prices down, there's a lot of new construction. When I was down there in Miami, I was walking around Wynwood, which is amazing, by the way. I was out with some friends in Wynwood. You see cranes everywhere. There's a new development that's coming up everywhere. There's sales showrooms for new condo units literally on every single block. So the good news is this. A lot of people have been complaining, right, that South Florida, particularly Miami, is becoming so expensive, where you can almost compare it to New York City. The way you kind of satiate a lot of that demand is just by building more units, right? Building more apartments. Miami-Dade County has a lot of new construction, in the pipeline. Not so much in New York City. It's very, very difficult to build here. So the only way developers can really make any money here is if they go crazy and build ultra luxury. So there's not a lot of new inventory in the pipeline over the next 3 to 5 years in New York City, but there is a ton of new inventory in the pipeline in Miami-Dade. So as that comes to market, I think that will, you know, hopefully put a lid on prices, hopefully. All right, everybody, just for some context here, we are now at Central Park South. This is East 59th Street, 5th Avenue. We're standing right outside of the GM building overlooking the Plaza Hotel. Gorgeous here. But one of the reasons why I wanted to take you to this spot tonight is for the following reason, okay? Now, as we sort of shift the camera around, you see the 5th Avenue Apple Store, the flagship here. You see the GM building, you see Dior. But you guys see this building right here? This is 5 East 59th Street. Now, talking about commercial real estate in New York City, I was telling you guys about this building for a long time. It's right next to the Sherry Netherland Hotel. The building is 2 retail units on the ground floor, and you have 8 office units throughout. It's this building right here. Now, this used to be the old Playboy Club, and I believe it had about $85 million worth of bad debt on it, and it went into foreclosure, and it just had its foreclosure auction on January 17th. Now, does anybody want to guess, okay? Does anybody want to take a guess in the chat at what this building sold for in foreclosure? This entire building in one of the most desirable neighborhoods, desirable locations anywhere in Manhattan, right next to the Sherry Netherland Hotel, right next to Central Park South and the Plaza. Does anybody want to guess what 5 East 59th Street sold for at auction? Now, as you guys know, I'm on the Kirsten Jordan team at Douglas Elliman, and Kirsten's husband, Stefano, is an incredibly talented real estate developer, has a very successful private equity firm, and we were working on this deal. I was running a lot of the financials and trying to raise money to acquire this building. Unfortunately, we didn't get it. We did not get it, but it sold at auction for $23 million. Now, whoever bought this is going to make a fortune. I mean, this is going to, it's just a great deal. Now, it needs a ton of work, right? You're going to need to do a complete gut renovation, but if you can pick this thing up for $23 million, I mean, guys, there's some apartments in Manhattan that go for $23 million, and you're going to get an entire office building for $23 million. If you renovate it, rehab it, move tenants in there, I mean, this is a $100 million building. This is a $100 million building. Central Park Tower, which you can see a little piece of it right here, right there. They just sold the second most expensive apartment in the building, I believe for $149 million, the apartment there, right? Incredible deal, amazing deal. Now, Douglas Elliman, I believe the Eklund Gomes team was represented the buyer on that deal. But it just goes to show, you know, when there's a lot of fear in the streets and when there's a lot of distress, right? A lot of very good properties that just unfortunately, you know, just due to the economic times of the high interest rates, you know, people can't afford to pay, you know, the note on it. There's going to continuously be fire sales, like foreclosure auctions on great properties in New York City. Now, a lot of people disagree with me, right? And they say that, you know, New York City commercial is never coming back. It's just a lost cause. It's going to be in the doldrums forever. Well, they said the same thing about New York City in general during COVID, right? They said nobody's ever going to want to live here anymore. The city's never going to come back. You know, the rents are going to stay low forever. And the rents have roared back, and it's more expensive than it's ever been here. So we'll keep tabs on this building. We'll keep an eye on it, 5 East 59th Street. And I think over the next 10 years, that is going to be, I mean, you can't get a better location than that. So congratulations to whoever bought that. They're going to make a fortune, and they deserve it because they, you know, took the risk. Hey, T-Cal, what's up? Good to see you. NBA Elias is how much will the renovations cost? We modeled it for about 20 million. Now, here's the thing. Now, here's the interesting thing, right? And you can see a little bit better when we cross the street. Let me cross the street, hold on. Now, I don't know if you can do this. I'm just sort of stipulating an idea. We were thinking about this, and I think you are allowed, but I don't know. I don't want to speak too soon. There's a space between this building and the Sherry Netherland. Now, we don't know who owns those air rights, but it is potentially possible where you could go to the city and get it zoned where you could add maybe 3 condos on top of that. I don't know if you're allowed to do it, but if you could, I mean, that's just icing on the cake for that deal. Great location, right next to the Apple Store GM building. It's an awesome place, awesome. Central Park. So, yeah, let's head to the plaza and then we'll head down. So just, you know, watch the market, watch a lot of these foreclosures. I mean, I can't believe that whole building went for 23 million. Now, obviously there's huge risk involved, right? You got to do the renovations and, you know, you got to try to find tenants to move into the office space, and, you know, the office environment here is very challenging in New York. But the calculated risk you take, or the bet you take, is that, you know, should you get an improved product right on the market, and should the city recover totally, and we have those occupancy levels of pre-pandemic, well, then that building is going to go re-rate all the way back to what it was worth before the pandemic. And I'm confident that that will happen. All right, let's head down 5th. And then we'll try to duck into Grand Central Terminal just so we can warm up a bit. But if you guys are enjoying the live stream so far tonight, feel free to leave a like on the video and click the subscribe button if you're new here. We do these live streams every night starting at 8:30, where we walk around the city, just have a chat, talk about the financial markets. And if you want to stay up to date on, you know, a lot of the breaking real estate news and stock market news, we write a free financial newsletter that we send out every other Thursday at the closing bell of the market. If you want to receive that, just go ahead and scan the QR code on your screen, or you could type !news, N-E-W-S, in the chat, and it will take you to our Substack. We publish all of our research every other week, and we just sent it out on Thursday night. We covered a lot, so head over there and let me know what you think. Marvin says 10% tariffs across the board for the future. What will affect global, or that will affect global markets? I haven't heard of that. 10% tariffs across the board. Tariffs for what and on who? Hey JC, what's up? Good to see you. Lance is here. Michael says, hey Tom, it's always good to see you in New York City. Thank you, sir. Appreciate it. All right, we'll take one more peek at Billionaires Row here. Again, you have Steinway, Central Park Tower, 220 Central Park South. Someone says, isn't it too crowded, or it isn't that crowded? Well, there's not a lot of people walking around the city right now because it's like 10 o'clock at night. It's freezing, right? It's like 20 degrees with the wind chill. It's probably in the high teens. It's freezing out. Let's continue to walk down. Now this is the Tiffany building. LVMH purchased Tiffany in a very, very, I would say, strategic acquisition. And they totally renovated and remodeled the building. They put about $500 million worth of work into it. And I think it looks phenomenal. Now the top floor, I believe, is the restaurant. I haven't been there, but maybe that should be on the bucket list of places to go. Dan Sang is here. What's up? Good to see you. Thanks for joining us on this very frigid night in Manhattan. Definitely quite the shell shock from Miami, Florida, but hey, IPDS, it's a beautiful night in New York City. What's going on? Hey, Peter says, what do you think of the new Aman Hotel in the Crown Building? Yeah, Aman, New York is right here. Right here on the corner of West 57th Street. I think it's a very strategically placed location, right? Now, Aman is one of the most expensive hotel franchises, most luxurious in the world. So it makes sense that it would be on Billionaires Row. Now, when I was down in Miami, right on Collins Avenue, I was riding the Vespa up Collins. Aman is going to be building, I think it's already under construction. Right on the water, it's going to be Aman Miami, which makes sense, right? If you have a location in New York City, I mean, at Miami Beach, that's an amazing, amazing location. I've never stayed there for obvious reasons. I think per night, it starts at $1,100 or $1,200, maybe even $2,000 a night to stay there, which is kind of crazy. All right, let's cross and go to the other side. Now, there's a lot of tariff talk in the chat. I'm not too sure that's ever going to be a thing. 10% across the board on all products. I've never even heard that. But I think in general, the relationship between the US, Mexico, and Canada is probably going to get increasingly stronger over the years, right? For topics that we've covered almost to the point of ad nauseum on the live stream, right? As you're having this decoupling from China specifically, you're going to have a massive reshoring, massive reshoring. Just take a look at the Mexican ETF. I'm blanking on the ticker symbol because it's so cold. I think it's EWW. Could we get somebody to check that out for us? What is the ticker symbol for the Mexican equity market, the ETF? I think it's EWW if you want to check that out on Google. Anyway, you know, Mexican equities are actually performing quite well. So, you know, there's a lot of talk about, you know, the decline of the United States and Mexico. I think I'll take the opposite side of that trade. I think between the US, Canada, and Mexico, I kind of take the opinion of Jamie Dimon, actually. Now, Jamie Dimon is the CEO of JP Morgan Chase, and he sort of lays out an interesting thesis that I agree with very much. He says America really doesn't know how lucky it is, right? We really take for granted, you know, just how lucky we are in this country because we have the best neighbors in the world, right? I mean, and we're so strategically protected, right? Literally from sea to shining sea. We have the ocean, the Atlantic Ocean to our right, the Pacific Ocean to our left. To the north, we have our good friends from Canada that are fantastic, which we love dearly. And we have the Mexicans, which are great trade partners. And it's a very forward-thinking, progressive nation that is going to benefit extremely well. So there's a lot of analyst reports that I'll read that'll be like, you know, a lot of these European equities are so undervalued on all these different metrics, right? Price to sales, price to book, all that, you know, kind of stuff. But sometimes, and this is kind of how it was explained to me by a really successful hedge fund manager who I have a lot of respect for. He says sometimes, you know, the market will price stocks high or expensive for a reason, right? And sometimes stocks will be cheap for a reason. So just because, you know, on paper, you know, a lot of these European equities could be quote unquote cheap, there's a reason they're cheap, right? Because potentially one of the reasons is the risk factor of, you know, geopolitical risks. You know, I mean, just think about Europe's position with energy. I mean, the United States is pretty much completely independent. We don't have to rely on imports or exports. It's not the same in Europe, right? So, I don't know. I think as you have this reshoring and massive movement away from China, North America in general is going to benefit. I think Latin America is going to benefit. And that could be, you know, to sort of spin off the conversation as we're looking at the University Club. I think that's why you're seeing a lot more companies, businesses set up headquarters or satellite offices in Miami, particularly in the financial world, because that kind of acts as the, you know, the golden gate, if you will, to Latin America is Miami. And if you're going to have a lot more business in Latin America due to, you know, the shift in manufacturing from China to Latin American countries, well, it would be wise to have locations in terms of the financial world, financial institutions, lenders, and things like that in South Florida. So, hey, Robert Parker, what's up? Good to see you. He says, hey, Tom, did you discuss the record Dow closing above $38,000 for the first time? Yeah, pretty much all equity markets are racing into new all-time record highs. The only one, right, is just the Russell 2000 is the laggard, right, for reasons we've discussed. But Robert Parker, you're absolutely right. The question is, will small caps really start to participate? All right, guys, check this out. This is the beautiful St. Thomas Church right here on 5th Avenue. Look at that. The mighty bull. Yeah, it's true. Zozo Bob. You're right. Just catch up on some of the comments. Karina Thompson is joining us. What's up? Bree Grams. Carl Roth says we love the USA. We all do the right things to keep it going, for sure. Marvin says, think of the future. If T becomes the man again, good luck. Oh, you're referring to Trump? Maybe. I think, regardless of who wins the election, I think the United States will be just fine. I think if, President Biden gets reelected, which isn't the desired outcome I would want, but I still think the country would do fine. If Donald Trump gets elected again, I think a lot of people would be upset. I think a lot of people would be very happy, and I think the country would do just fine. This is going to be the new Rolex building. That's going to be a cool project. It's going to be cool as we walk up and down 5th Avenue and see that building go up. Wow, look at this. Peter says you're naive if you think that. Maybe I am. Look at this. Guys, not a soul on the street here. That's how cold it is. Look at that. It's kind of a cool shot. Because I'm so used to walking down 5th Avenue during the holidays, right? Christmas, New Year's, so many tourists, incredible. And now it's kind of like a ghost town because it's so cold and there's not a lot of tourists here. NBA Elias is in 2024. Forget Biden and Trump. Focus on Powell and the Fed. Yeah, that's a really good point. I've always said this, and not to sound like a broken record, but I think it's important to sort of, dictate it again. Many people, right? Many people think that, they like to point to the scoreboard and say, when Donald Trump was president, the stock markets were at all-time record highs. And then now that the stock market is at all-time record highs, they say, look, the stock market is hitting new all-time record highs under Joe Biden, right? They must be doing such a great job. It's of my opinion, and again, this is my opinion, stock market performance has very little to do with who the president of the United States is. You really got to focus on monetary policy. Right now, it's very important, right? Fiscal policy too, because that impacts stock prices, right? The more money, the government spends on infrastructure, it stimulates the economy, but more so, it's about who prices money, right? The money business or capitalism is essentially all about the cost of money or the cost of capital, and who controls the cost of money or the cost of capital. Well, it's in general, right? The Fed funds rate is set by the Federal Reserve. So if you have a Fed that is very accommodative, right? They're printing a bunch of money by expanding the size of their balance sheet, right? So if you go to the Federal Reserve or the St. Louis Fed website, right? If you go to the St. Louis Fed website and look at all of the FRED data, F-R-E-D data, you can see the size of the Fed balance sheet in real time. And the Fed balance sheet is made up of mainly two things: mortgage-backed securities and treasuries. And the Federal Reserve does that to provide liquidity in the market. But they also adjust interest rates to the Fed funds rate. So if you have a Fed, right, that leaves interest rates artificially suppressed and they continuously balloon the size of their balance sheet, right, to provide liquidity to the market, well, what does that mean? Well, that means companies or businesses that are publicly traded, they're more incentivized to take on debt, right? So debt acquisition goes to the moon. They can use that to spend on expanding their business, hiring more employees, and it provides liquidity to the market. And equities generally go through a multiple expansion and stocks generally tend to go up. But if you have a very, very tight Fed, you tend to have, very harsh corrections in the market, like the one that we're just emerging from now. So right as the Federal Reserve started to raise interest rates and shrink the size of its balance sheet, we had a very nasty bear market. A very nasty bear market. A lot of people don't realize that, but it's true. We wrote about this. The NASDAQ was down over 35%. So if the NASDAQ is down 35%, if you look at the individual stocks in the indice, right, if you have a higher beta, right, we've talked about beta weighting portfolios before, stocks with higher betas, they're going to go down. If the NASDAQ's down 35%, there's some stocks that went down 90%. Right, look at a lot of these, SaaS, software as a service stocks. So I guess in conclusion, yes, does the president matter? To a degree, but I think presidents take too much credit when the stock market is doing good, and they get too much blame when it's not doing good. I don't think they influence it as much as people think, right? I kind of chuckle a little bit when people say, see, it's all because of Trump that the stock market was at all-time highs, or it was all because of Joe Biden because the stock market's at all-time highs. The market doesn't care who's president to an extent. It's really, I would say, more weighting on monetary policy. How accommodative is the Fed, right? How restrictive is the Fed? So I would say the Federal Reserve Chairman Jerome Powell is more powerful than the President of the United States. That's what I would say. I think the chairman of the Federal Reserve is more powerful than the president of the United States, in my opinion. Guys, this is still up here on Saks Fifth Avenue. Look at that. I can't believe this is still up. Let's take a closer look at it. And then I'll catch up on the comments in just a moment. I actually am kind of happy that they still have the holiday display up on the side of Saks Fifth Avenue. Oh, although it does look like they're taking it down slowly but surely. Hey, Luis Martinez. Good to see you, Luis. Luis, thank you so much. John Kelly's 100% agreed. The info can always be manipulated to fit the narrative. For sure, for sure. Marvin should have started raising rates back in 2018, but someone didn't want that to happen. Yeah. Yeah, the Federal Reserve is supposed to act independently from the government, right? Just because it has the name federal in it, people think it's part of the government. It's not. It's a private entity. So look, hey, that is true. When Trump was president, right, he would, Fed Chair Jerome Powell really wanted to raise interest rates. And Trump was like, no, you would kill the economy, and I'm going to fire you. Essentially is what the guy implied if the Fed would raise rates. Because it's a political game, right? The market probably would have threw, a taper tantrum, right? And, went down a little bit or went into a correction. Yeah, NBA Elias says our credit card rates went up because of Powell, not Biden or Trump. Yeah, and that's the thing, like, the vast majority of the American populace, right, don't understand this. And maybe they shouldn't, right? I mean, people are busy, right? But politicians use this kind of stuff to their advantage, right? They say, "Oh my gosh, look at the reason why you can't buy a house today because interest rates are so high is because of President Joe Biden." It's not. And if the election was today and somebody said, "Okay, if you only had to vote between Joe Biden and Donald Trump, I would vote for Donald Trump." I respect everybody's political choices. But I was watching some of the debates, right? And one of the talking points for a lot of the Republican candidates is, hey, when Trump was president, you had mortgage rates at 3%. Under Biden, they went to 8%. Okay, it's like Joe Biden doesn't set interest rates. You think Joe Biden controls the bond market? He doesn't. It's the Federal Reserve who raises interest rates, and then therefore the market has to adjust to reprice for a higher rate environment. So, but again, politicians, both on the right and the left, they know that the vast majority of people aren't, I guess, educated in this stuff. So they just, get for everybody, okay? So if you're interested in the financial markets, if you're interested in the proper way, okay, how to evaluate businesses, how to evaluate companies, there is arguably one of the greatest professors in finance in the world that teaches at New York University, the Stern School of Business. Professor DeMontmoran, right? Now, he teaches two very sought-after courses, one of which being corporate finance, and the second one being securities analysis. Now, these are very expensive courses to take at NYU, Stern School of Business, so he offers them for free online. Now, you're obviously not going to get any, college credits or anything. But that doesn't matter. What matters is you learning the material so you can be self-sufficient. So if you want to take those courses for free, you have the entire syllabus you can download, all of the lectures, every single lecture he's done is available for free for everybody. And And to top it off, last but not least, you could even take the exams. So you could take the corporate finance and the security analysis exam at NYU Stern for free. If you want to sign up and be a part of that, if you scan the QR code on your screen and punch in your email, it's going to take you to our Substack. And in the last newsletter that I sent out to everybody, I put the link there. Also, if you download the Substack application and you go to the Walks in Wall Street chat, I put the syllabus there. So you can click the chat and all of it's there for free. So if you're interested in finance, corporate finance, or securities analysis, take advantage of that free resource. Okay, it costs you nothing. Just invest a little bit of time. All of the lectures are there, right? This is MBA level courses, and it's all for free. So again, if you just scan the QR code, punch in your email, you'll be signed up to receive our Behind the Street newsletter. The link is there for the DeModern NYU course, or you could type !news, NEWS, in the chat, and you could also get it that way. This is 50 West 50th Street, Rockefeller Center. Try to walk down and around. But if you guys are enjoying the stream so far tonight, you can feel free to leave a like on the video and click the subscribe button if you're new. We do these live streams every night starting at 8:30, walking around New York City, talking about the financial markets. Hey, Walking Minnesota, this is Tom. As a walker, how do you feel about the New York City congestion pricing? I'm against it. I think it's just another tax on the middle class here in New York City. And it's kind of a way for New York City to make a couple bucks to compensate for their, I would really say, derelict in their duties to run a fiscally responsible city. So they're trying to, nickel and dime everybody to try to make up for it. So I'm against the congestion pricing. For those of you who don't know, if you drive a car in New York City, south of 60th Street, you're gonna have to pay a toll every day. I think that toll is $15. I'm not too sure the exact amount. I don't have a car, I don't drive, but hey, Theo, good to see you. Hey, Tom, great to see you back in New York. Thanks so much. I just landed here Sunday. I had a very good trip to Miami. Very successful trip. We'll be seeing a lot more deal flow down in South Florida, which we are excited about. You can see News Corporation across the street. Right, this is the News Corporation building. So a lot of times when we cover the financial markets, A lot of these topics that we get are from a newspaper called Investors Business Daily. Now, News Corp, which owns Fox News, the Wall Street Journal, Barron's, recently acquired IBD, or Investors Business Daily. Now, in 2023, unfortunately, the founder of IBD, or Investors Business Daily, passed away, William J. O'Neill. He's arguably one of the greatest position size traders that ever lived. William J. O'Neill. He founded Investors Business Daily, as well as O'Neill Securities. I always recommend this book. I think it's one of the greatest books on stock trading. It's called How to Make Money in Stocks by William J. O'Neill. He founded the Can Slim investing methodology. And we lost a lot of investing greats in 2023. 3 of which I wrote an article about. If you want to read that, just go over to our Substack. We lost Sam Zell, who's a very famous and extremely successful American success story. Big private equity real estate icon, unfortunately passed away last year. We had Warren Buffett's right-hand man pass away last year. And we also had William J. O'Neill. I think they always say the legends kind of pass away in threes. I think those were our main 3 for last year. Coming up on Bank of America Tower. Yeah, Talent 103 says get some diamonds. We just passed the New York City Diamond District. I gotta walk all the way down to 30th Street. Might as well take you guys with me. But what is everybody thinking about for next week? Obviously, if you go to the Federal Reserve's website and you click their schedule, the 30th through the 31st of January, so next week, it's already the end of January, where you're going to have the first FOMC meeting of the year. So if we had to take a little bit of a poll with everybody in the chat, what do you think? Do you think the Federal Reserve is going to hold steady in terms of interest rate policy? Do you think they're going to hike? Or do you think they're going to cut? They're obviously probably not going to hike interest rates. I think they'll probably hold rates steady yet again. You can kind of see Times Square a little bit in the distance. We're going to take a little detour and go through Grand Central Terminal just to try to warm up a little bit. So everybody's saying hold. Celtech says hold. Vinny, what's up, Vinny? Says hold. Now, one thing that I don't think a lot of people are paying attention to, and once again, if you go to the St. Louis Fed website, okay, if you go to the St. Louis Fed website and you look at the balance sheet, you know, the Federal Reserve is still shrinking quite substantially the size of the balance sheet, right? So there's really 2 ways the Fed pulls the triggers or pulls, you know, the strings on the economy, if you will. It's through setting interest rates, the Fed funds rate, which currently is in a range of 5.25 to 5.5%, but they also have the balance sheet, which is made up of mortgage-backed securities and US Treasuries, and they've been letting a lot roll off that balance sheet. And essentially that kind of, pulls the strings on the liquidity in the market. So when people say, oh, the Fed is printing a ton of money, right? Anybody ever heard that saying, oh, the Fed is just printing money? That's how they print money. They buy mortgage-backed securities and US Treasuries. They print it digitally. Just numbers on a screen. But we'll see. Another good tool that I think everybody should pay attention to and look at, which we included in last week's Behind the Street newsletter, is the CME Fed Watch tool. So if you kind of want to get an idea of what the Federal Reserve may do at future Fed meetings, if you head over to the CME group, right, Big Futures, the Fed Watch tool, it will give you probabilities on sort of what the market is pricing in. And according to the Fed Watch tool, look at this. This is an original firehouse, New York City firehouse. Look at that. Love that. But if you look at it, the market is assigning about a 34% likelihood that by the end of 2024, the Fed funds rate is going to be, I think, between 3 3/4 and 4%. I don't know. I don't know. I'm not too sure about that. I think if that materializes, we'll see. That could potentially put in jeopardy everything the Fed has worked so hard to do, right? Kill inflation. So, Fed Chair Jerome Powell is a smart guy. Okay, I don't think he's a dumb person. I think he's a very smart guy. I think he's done as good of a job as he can so far. And I don't think he would want to jeopardize his progress on bringing inflation down to the 2% target by cutting interest rates prematurely. Now, here's my take on it, and I want to know your thoughts. I want to know what you think. If I was the Federal Reserve Chairman, okay, and I'm looking at the market, and I see the S&P 500, the NASDAQ, the Dow Jones Industrial Average, screaming to new all-time record highs, okay? I see a lot of different sectors in the market performing really well, from semiconductors to home builders, right? We wrote a whole article on that, about how well the home builders are performing. Is the first thing that I'm gonna say is, oh, you know what? Equity markets are at all-time record highs. Crude oil is under $80 a barrel. Yeah, I'm gonna go ahead and start cutting interest rates to stimulate the economy. I don't know. I just don't see a reason for that. Now, I was watching some interviews of some major, Wall Street mega bank CEOs at Davos, which I can't stand. I actually get a little bit nauseous. I could feel, it's just like I get a little bit nauseous. My head starts to hurt when I even think about Davos. But in any event, there's been a lot of CEOs out there that are saying, look, we're seeing signs of softening in the economy, and we think the Fed is going to be forced to cut rates. I just don't I just don't see the justification. It would just look weird if you're like, great, markets at all-time record highs, unemployment is still relatively low, let's stimulate. It would just be, to me, it'd be weird. But we'll see. We'll see. All right, let me catch up on some of the comments. I haven't been reading any. Apologize. Peter says, what increments do you expect with each Fed move? 25 basis points. By the end of the year, I expect rates to be in the 4% range. Yeah, I mean, well, that's what the futures market is saying, right? I mean, I couldn't see in a million years, Fed Chair Jerome Powell saying we're going to cut by 75 basis points. Like, for what? For what? Like, think about, back to the Paul Volcker days. He had to crank interest rates to 20% to kill off inflation. So you don't want to kind of, raise the victory flag too soon. However, if you listen to a lot of the speeches post FOMC meeting, the Fed chair has been very steadfast in saying, look, we are still ready and prepared to deploy all tools necessary to get inflation back down to the 2% target. And it's not a 2%. What was the last inflation print? Everybody, 3.4? Anybody know? I forget, I'm blanking. What was the last CPI print that we had a couple weeks ago? 3.4%? 3.2? What was it? I'm trying to think. Anyway, I think you get the point. 58 says, but isn't housing the key metric driving up CPI? Would lower rates affect that much? This is 3.4%. Got it. No, you're 100% right. So you're correct. So the largest component, or I should say one of the largest components of CPI is shelter costs, right? And if you type CPI, so CPI in the chat, it's going to drop you the link to the Bureau of Labor Statistics CPI infographic. Hold on, let's just get inside. Whew, man. All right, hold on, just bear with me 2 seconds. Sorry about that. I just had to plug in the phone. All right, well, welcome to Grand Central Terminal. Feels really nice here. But anyway, that comment was a very good comment. Very true, very, very good. Now, again, if you type CPI in the chat, so once again, CPI, this is a very, very useful tool. And again, all these tools that I give you are free. The public doesn't really know, the general public really doesn't utilize them as much as they should. But that'll give you the link to the Bureau of Labor Statistics CPI infographic. Now, what's cool about that is it breaks down the CPI report in a visual sort of graph by component. So if you deselect everything on the chart, and you only select shelter, you can see that it was extremely lagged, right? So shelter is very, very, it has a very, very lagged effect to interest rate hikes. So the more liquid, right, not sound like a broken record, we've gone over this a lot, but the more liquid an asset class is, so the more liquidity it has, generally speaking, the faster it reprices to a higher interest rate environment. So as rates go up, what usually happens first in the housing market is deal transactions slow down and grind to a halt, right? Not necessarily prices come down right away. What first happens is deal flow, right, or transactions, and you could see this in the data. If you go to the National Association of Realtors website, Google how many homes were sold in 2021 and Google how many homes were sold in 2022 and 2023. It completely fell off a cliff. It cratered. But not necessarily price cratered, right? Valuations didn't necessarily crater. it's just deal flow and transactions seize up, and then you have a little bit of a markdown. You don't necessarily have to have a whole falling out of the market, but then you have softening in the market, right? So if the Fed stays steadfast in, leaving rates where they are, and if shelter costs fall back down to where they were pre-pandemic in terms of the component, yeah, I think the Fed will be successful in getting their target of 2% CPI. I think that would materialize. But if they start to cut, it could essentially screw up the over year and a half of progress that we've made. So who knows? Hey, marketing videography. This is following you to Miami. New York City winters, you stay indoors. In Miami summers, stay indoors. Yeah, I mean, a lot of people don't like South Florida in the summer because it's so humid. I like the humidity. I'm weird. I get it. It's weird. South Florida is like a swamp in the summer, but I like that. I know it's weird. Many people can't handle being in South Florida in August. I love it. The hotter the better, but let's go down to the second floor, or say the basement. NBA Elias says this current stock market rally is an expectation of Fed rate cuts later this year. Market may drop if Fed does not cut. That's actually a good point. It's actually a very good point. There's chandeliers. Hey, Marvin, says Tom, have a great night. Safe travels. Thank you so much, Marvin. I appreciate you, and thank you for your insights on tonight's stream. I appreciate it very much. Casey says, is this Grand Central Terminal? It is Grand Central. And we're actually walking directly under the very famous Whisper wall right here. So if you stand right in this corner, so if you stand right here, and somebody else stands over here, and if you speak into the wall, your sound is going to travel all the way across and down to the next person. It's kind of cool. If you're visiting New York City, try it. It works. $25.48 says it seems a lot emptier than you'd expect. Yeah, well, I mean, the city's freezing and it's January now. Right? If you were watching the live stream out, so there's not a lot of tourists. Nobody really wants to tour New York City in the depths of January and February when it's freezing, it's gray, it's dark, it's snowing, it's raining. They want to, visit it during the holidays and in the fall and in the summer when it's nice. Let's exit to the right. Yeah, Latha, that's also true. It's Monday night at 10:30 p.m. People got to work tomorrow, including me. I got to be up early. I'm probably going to head to sleep early tonight too. Well, to look on the bright side of things, January is almost over, right? We just have the full month of February, and then, you know, usually March is not the best weather, but we're almost done with the cold and the winter. I missed almost all the snow when I was down in Miami. Hey, Sharon Williams. Hey, Tom just came in. What's up, Sharon? Pershing Square, Mr. Bill Ackman. Now, Bill Ackman has been waging war against Business Insider. Has anybody been watching those events unfold on Twitter? Or I should say X? I'll say one thing. You know, Bill Ackman, he definitely stands for what he believes in. And he will pursue his beliefs relentlessly in perpetuity. I really enjoyed his recent interview with Andrew Ross Sorkin of CNBC. I thought that interview was so good. If you haven't watched it, check it out. You can kind of gauge the temperature that some people are kind of getting fed up with all the craziness going on. This is One Vanderbilt, right outside of the MetLife building. Now, apparently Business Insider wrote this baseless hit piece on Bill Ackman's wife, I guess accusing her of plagiarizing or something way back in her college days. It was kind of a very weird event. And I guess allegedly Bill Ackman is going to pursue legal proceedings against Business Insider for defamation. I know, love the beach, says I love that view. This one's pretty good too, looking directly at Grand Central Terminal and Pershing Square. We have a couple more blocks to walk down. Well, not a couple, 10. Hey, Andy is joining us from South Korea. What's going on, Andy? Thanks for joining us. We were talking a little bit about the Korean Kospi in our previous newsletter. The Korean equity markets are doing very well. So is Japan and India. We've had many conversations on the stream about the bull case for the Indian economy. We're walking down Park Avenue now. No, I didn't hear about that. Someone's like, Tom, did you hear about the New York Times lawsuit against OpenAI? You know, I haven't, but I have some questions. Because what's interesting is, if you think about, you know, what all these chatbots are, right? Like ChatGPT and the like. Essentially, it's just a curation of what's out there and available on the internet. So, you know, if you talk about, you know, plagiarism and things like that, I mean, how do you stop AI from plagiarizing? I mean, you've essentially just opened up a whole can of worms there. Because if you ask ChatGPT a question, right, how do you think it's getting your answer? It's scouring the internet, right, to curate an answer. So I don't know how I don't know what's going to really become of that, right? And I was thinking, on this perspective too. What happens if you ask ChatGPT to summarize like a book, right? Say, hey, ChatGPT, summarize, One Up on Wall Street by, Peter Lynch. And ChatGPT is going to give you a full blast summary. That's probably better than reading the actual book. So like, I don't know. It's weird. I don't have the answer to it. But I mean, can you just sue the algorithm? I don't understand. It's interesting. Check the logic. Says ChatGPT will have to provide a reference list. Maybe. Jeff W277, hilarious. Yeah, Brad's brain says, won't it be just like Wikipedia, just people updating stuff? I mean, I don't know. I really don't know. I don't know the answer to that. It's weird, right? Because, I mean, the internet created its own set of issues. I think AI and these chatbots, and I use the term issue very loosely as like I can't think of another word, but I mean, I don't know. I guess it can provide a book summary. Maybe it would take business away from people actually purchasing those books. But assuming AI has read every single book known to mankind, if you say, hey, summarize the, Common Stocks and Uncommon Profits by Phil Fisher, ChatGPT is going to spit out like a 5-page clear and concise Spark Notes on the book. Somebody's telling me to talk a little bit about the yield curve. Yeah, I think yield curve analysis is very important. It's very important to understand what it is and why it inverts, why the yield curve is flat, and what a steep yield curve is, right? And we've written about this. I actually wrote an entire piece about it. So if you want to have it for reference, right, and use it freely, if you type !news, NEWS in the chat, the Nightbot is going to drop the link to my Substack, and I believe I wrote about it in the article that was titled "Bad News, Positive for the Market." I think it was in that issue. Well, look at this. And essentially, what I think is important, right, is not necessarily where the yield curve is right now, right? Because a lot of people talk about, oh, the yield curve is inverted, or the yield curve is flat, or the yield curve is steepening. It's very steep. It's more important to understand where the yield curve was, where it is coming from, and where it is going. Like, where is it in the transition period, right? Because the yield curve gets steep for a reason, it gets flat for a reason, and it gets inverted for a reason. So if you think about the curve, right? If you go to cnbc.com/bonds, cnbc.com/bonds, you'll be able to see the yield curve, right? All the different maturities. Now, the long end of the curve, you'll kind of have your long duration, like 30-year and the like. And if you think just in very basic layman's terms, right? There's an inverse correlation in the bond market, in the debt market. So as bond prices go up, the yields come down. And as bond prices sell off, the yields go up, right? So anytime you hear the news saying, the bond market sold off today, well, that means yields went up. So if portfolio managers, right, and PMs and the like, this is another really good shot of the Empire State Building, if they have a very pessimistic outlook on the state of the United States economy, well then, instead of deploying money in equities or stocks, instead of buying stocks, they're going to say, you know what, we're totally okay with locking up our money for long durations. So we're going to buy long dated debt, right? We're going to buy long-term debt. So think about sort of what we just talked about, right? So if you have a yield curve that looks steep, right? So it kind of goes like that. That's a normal looking yield curve. It's called very steep. As you have portfolio managers and investors on the street saying, ooh, I'm a little bit nervous about the state of the economy. I think stocks are going to go down. Let me pile in to long duration debt because I'm happy with locking up my money long term to get, X amount of yield in return. So as money piles in to long duration debt, that brings yields down on the longer end of the curve. And as you're selling shorter duration debt, that makes the yields go up on the shorter end, right? So over time, that creates the yield curve to become steep and then eventually invert, right? And then vice versa. So it's actually good to go in Microsoft Excel, right? If you go to Microsoft Excel, and you could just dot plot the yield curve and you could update it every month or every 2 months. And then over a long period of time, you're going to have this model where you can kind of, play with it and see if you have any correlations between, when did the market sell off? Because, the market actually generally tends to sell off during the transition from inverted to uninverting, right? There's also a very good YouTube video on this. I'm blanking on the name of the gentleman. He's a really smart guy. Khan Academy, if anybody's familiar with that. I think that's such a good resource. If you just type in Khan Academy yield curve, he gives in the exact explanation I gave, but with visuals. I'm a visual learner. It's just how I learn. But generally speaking, that's the yield curve, right? Remember, there's an inverse correlation in the bond market. As people start buying bonds, the yields go down. And as bonds start to sell off, right, yields go up. Okay, East 31st Street and Park Avenue. Very, very seldom do we come over this way on the stream. This is a pretty cool neighborhood. Obviously, Park Avenue, you can go 2 ways, uptown and downtown. Josie is here. What's up? But again, if you want to, have a deeper dive, I sort of wrote about the yield curve, explaining what it is, its transitionary period. If you want to check that out, if you just scan the QR code on your screen and punch in your email, you'll be signed up to receive our free investing newsletter called Behind the Street. We send it out every other Thursday, right as the market closes. If you can't scan the QR code, you can just type !news, NEWS. I'm going to call it a night right here on the corner of East 31st Street and Park Avenue. So if you enjoyed the live streams every day starting at 8:30, thanks so much for joining. We will see you guys tomorrow. Western Mass Dave, appreciate it. Sharon Williams, thank you. The Mighty Bull, go for Hokies. All of our great moderators, Hawaii, the Mighty Bull, T-Cal, Lay the. Remember, there's always a bull market somewhere. You just need to know where to look. Go ahead, check your emails, guys, and the newsletter is in there. If you want to sign up, just scan the QR code on the screen. Again, we send our free financial newsletter out to everybody every other Thursday. So appreciate it. Enjoy. God bless. There's always a bull market somewhere. You just need to know where to look. See you tomorrow.